in the Hang Seng market, so that's down around 0.4%. You have the Nikkei, which is trading around 0.25% lower.
So the first marker is the 20-day moving average, which is for the Nifty stands at 19,626.
We think it's a time for foreign investors to re-engage with the market.
The weakness comes in from the top line itself. The volume growth of the company this time around has been absolutely flat.
Anfield will transfer about 6.5 crore of shares to Vijay Shekhar Sharma. So this is about 10.3% of equity.
There you go, the first tick on the index, so holding on to 19,550, climbing a little bit, up about 40 odd points.
We will find our reasons to have a shakeout, to have a correction. 5-7% kind of a correction cannot be ruled out.
This is a 400 crore investment in a sector that we know very well, that is a core sector for us.
Bit negatively surprised by the extent of margin compression shown by some of the large banks like SBI and BOB.
Suddenly, in the last 15 minutes, markets have turned for the worse and the Nifty has slipped. The sensex has slipped from the day's high.
The new launches that have happened in the PV space will definitely drive out demand.
Pretty good-looking screen right now, Markets are holding up with a gain of about 85 points.
Well, that was the day so far. You're with us here in a fresh new edition of Closing Bell this Monday afternoon. We are coming to you live from the CNBC-TV18 News Online studios. I'm Prashant. With me, my colleagues Rima and Surupi here in the studios. Guys, hi, good afternoon.
Hi, good afternoon.
And Nigel is joining us as always from the newsroom floor. Guys, hi. Nigel, hi. Well, the day's high, I think, is the 20-day moving average. That's the story so far. And, we were talking about how that's the first marker to cross. It doesn't look like we will. It looks like we perhaps will have a test again. So the day high is 19,621. The 20-day is 19,626. So almost a touch of the 20-day, and then some selling starting to emerge. Let's see. I think we need a close above it for confidence to come back. That will kind of affirm the fact once again that Friday's bounce that we saw was not just a corrective bounce, and that more selling perhaps is still to be coming. So a close above the 20 is the first marker. The bounce of the bank Nifty has been much weaker, by the way. The Nifty is doing what it is, but take a look at the Nifty bank. Nowhere close to what the Nifty's done at the day's high today. There you go. It's absolutely flat. Pharma is doing well. IT is doing well. And real estate. These are the three areas which are standing out with gains. And PSU banks are a little lower. And market breadth is positive, and there is so much action and activity in the broader markets. But it's kind of two-way, in terms of the number of stocks which are up, certainly more than the number of stocks which are down, but enough and more stocks down with volumes as well. And I think that kind of stands out. Lots of earnings which came out over the weekend, post-Friday all the way till Sunday. A lot of them missed expectations, and you got red across most of those stocks as well. Rima.
Hi, the one sector which stands out in terms of red is the PSU banks. Yeah. The Nifty PSU banking index is down close to about 0.7%. And pull up the intraday chart of a stock like, say, a Bank of Baroda. Bank of Baroda was holding up in the green. It opened up in the green, but now Bank of Baroda is down close to about 1.5%. So PSU banks is selling off as the day progressed. State Bank of India continues to bleed red even right now. That's the intraday chart of some of these PSU banks. Britannia is the other big loser today. The top loser, in fact, down 3% as it's getting hit by local competition, and the company had to undertake price correction. A couple of auto names like Bajaj Auto, Tata Motors are also amongst the big losers. There are three sectors where you are seeing strength. One of them is NBFC. So pull up a Repco Home Finance, a PFC, REC. You're seeing gains in the range of about 6 to 7%. So that's one, pocket of strength today. The other one is IT and pharma. So both the exporting, sectors are higher in trade. So the Nifty IT index is a gain of close to about 0.8%. But look at the pharma gainers: Divi's Laboratory, Aurobindo Pharma, Ipca Laboratories, Syngene. Across the board, pharma has made quite the comeback over the last couple of days. So maybe, now that the banking earnings, we haven't seen any upgrades. In fact, some of them have seen downgrades. Maybe we are seeing a bit of a sectoral rotation away from the banks and into IT and pharma.
Well, pharma for sure. I was looking at today's listing as well, by the way, Yatharth Hospital. Haven't mentioned that one much. But now it's actually looking much better. Maybe it is the fact that, as Rima mentioned, that there is a sectoral tailwind for pharmaceuticals and healthcare. That stock, which has just started its journey on the street, is up about 10%. Yatharth Hospital is what I'm talking about. So that's one mover and shaker. Overall, mid-caps haven't done that bad. I mean, the mid-cap index had flattened out around 1130-12. But there's a pickup and there's a lot of movement beneath the surface. Must point that out. Prashant mentioned real estate. I'll take some examples. Look at Keystone Realtors. Came out with a blowout set of numbers just a while back. The profits have surged and even revenues have picked up in a very substantial way, almost 60-65% up on the revenue. And that is what the stock has instantly done. It's just gone ahead and locked itself in circuit. Even some of the other companies like Colte Partl, etc., on the realty side, they're doing pretty well. And then you have the new age side of the market. Paytm with its announcements, and you'll hear more on it as we go forward with the Vijay Shekhar Sharma increasing his stake. It's a newsmaker, all right. And that stock's been up about 6%. And Zomato is still delivering appetizing returns. You can say that today, 5% up on Zomato as well. So mid-cap market short point is not bad at all. In fact, there's a lot of interesting stock selection that's going on out there. Nigel, what do you have your eye on?
Well, Surbhi, you said it, right? Mid-cap action is good. The problem for the Nifty is the big constituent. That's the Nifty bank or the banking names that have close to around 30% weight on the Nifty. Well, they are underperforming. So that's a bit of an issue. And now we're getting to a bit of a tricky zone because we're close to around the 20 DMA. And as we speak, the PCR, just a few sessions ago, it had gone down to around 0.6. On this show itself, 0.62, I recall. And from there, now it's at around 1.2. So that's telling you the action on the put side has picked up, while some of those calls that were written, they're getting unbound. So let's pull up a couple of strikes. The 19,500 put, well, that's fairly active in today's trading session. And the 19,600 call as well is fairly active. So to give you a broad range, the 19,600 call, the premium's around 65 to 70 rupees the last time I checked. So the broad range is on the downside. You're counting on the 19,450 odd level holding out. If that breaks, then you're looking at 19,300, which we visited last week. And in fact, on the upside, since the 19,600 call is seeing a lot of addition with premium of around 65 to 70 rupees. So 19,600 plus 70 rupees. That's telling you the resistance comes in at around 19,670. Midway through, you'll have the 19,626, which is the 20 DMA. So those are the important marks to look at. But the big question is, how do you position yourself for the last hour of trade? To help us out with that, Mitesh Thakkar joins us on the show. Hi, Mitesh. Good afternoon. Well, the markets are holding up, but the Nifty Bank is not participating, which could be a bit of an issue because we need someone else to put their hand up and get counted. How are you reading it?
See, I think the Nifty Bank is one clearly underperforming the Nifty, and therefore I think, the deficit of that is being kind of met partially by Nifty IT and to a certain extent by Nifty Pharma. Nifty Pharma has had a run, so I think the next sector on the line on the upside should be IT. But otherwise, I think, we are now getting closer, Nigel, to the gap level which I discussed, 19,650, 700 zones. If that is not being cleared, then I think, in a day or two, we'll see strong selling emerge and the market should again go back to levels of 19,400 or below. And maybe this time break it on a closing basis, which it didn't do the other day because it just managed to close around that level. So I think the structure is not giving me a lot of comfort, but the Nifty IT is the only saving place. And that's where I think, traders can possibly look at identifying long positions. In fact, even on my recommendation list, I have Tech Mahindra as a buy with a stop below 1170 for targets of around 1220. And on the other side, a sell call on, so just a minute, on Gujarat Gas, which I would recommend selling with a stop at about 470 for targets of 440.
Got it. We'll come back to you, Mitesh. I just want to highlight one name. Rate gain numbers just flashed at the bottom of your screen as we were starting the show. Stocks up. It's basically gained 8% in the last 2 or 3 minutes of trade. That's a very large move coming through on rate gain. Look at that. That's happening as we speak. It's a 40 rupee move, 500 plus on rate gain. Profits have come in at 25 crores. It's a big jump. Revenues are up 80%, 214 crores as compared to 119 odd crores. And EBITDA is basically gone up almost, 4 times. 38 crores as compared to 12 odd crores for rate gain. So this is a super set of numbers coming through. And I think we'll have some, I think there's some margins also. Yeah.
So RateGain had done an acquisition. They'd done an acquisition of a company. So this top line growth of nearly 80% would have an element of inorganic. But what the company had guided last year is that they will do a top line growth of 55 to 58% this year. But if in Q1 the company has started off with an 80% growth, then is there scope for a revenue upside in their full year growth estimates? That's something that the street is going to be tracking. And secondly, look at the way the company's margins have been expanding. In Q1 of last year, same time last year, margins were 10%. In Q2, it went up to 14%. In Q3, it went up to 16.6%. And in the last 2 quarters, margins for the company have been at 17.6%. So again, a platform company. And as it's gaining scale, you are seeing, the efficiencies coming through, margins for the company also improving. So this is, your typical is new age tech companies, the platform companies. And,
and I think RateGain does travel.
It does travel. And so there is a natural tailwind to the industry that it's operating in also. But that's a RateGain for you. Very strong set of numbers. We'll try and get more clarity. But remember, the top line growth would have an element of the acquisition of Adara that they did a couple of months back. But South Indian cement companies like India Cements and Ramco are under pressure on the back of a weak set of Q1 numbers. Nigel, what have you sussed out from these numbers in terms of trends?
Well, both the numbers were disappointing, but for Ramco Cements, they trade at higher valuation, so that stock as well is getting a bit of a knock. While for India Cements, well, it trades at around $75 per ton. Let's start off with Ramco Cements first. Now, on the top line itself, there's a miss of closer around 100 crores. The EBITDA number as well has missed by closer around 60 crores, and the profitability as well has come in much lower. What was the reason of the miss on the top line? First, some part of the street was working with a number of around 4.4 to some, even Kota was expecting 4.5 million tons. They've delivered 4.3 million tons. So that's a little lower than what the street was working with. The other factors, realizations on a sequential basis are down by close to 4.5 to 5%, while the street was working with a contraction of 2 to around 3%. So that explains why the top line has seen a bit of a miss, and that's why the EBITDA per ton as well has come in sub 800 rupees per ton. Moving to the power and fuel cost, when on a per ton basis, that's up by close to 8% sequentially. On a year-on-year basis, it's up by close to 12%. The management says that they were sitting on some high cost of inventory, and that explains why, if you look at the blended cost of fuel, that's at around $170 per ton, and now you have coal as well as petcoke prices that are much lower. The benefit of that will flow in the coming quarters. Point number 3 is the finance cost. Well, that's gone up as well. Now, we know that they're doing some capex, so the debt numbers are around 4,400 crores. But the cost of borrowing as well has gone up. So put all these factors together explains why Ramco Cements, the numbers were disappointing, and the stock trades at around $130 to $140 per ton. So the room for error is a little lower. For India Cements, expectations were low, and they've delivered a little lower than what the street was working with. So top line, there was a bit of a miss of around 60 crores. The margins came in only at around 0.5%. The street wanted a number of close to around 2%. Let's run you through a couple of aspects. Other expenditure was up by close to around 4%, and also employee cost was a little bit higher. Now, the numbers are disappointing, but what supports the stock is the management commentary. Now, after a while, you're getting positive management commentary. They're talking about steps to modernize the plants, and that's why it improves the operational efficiency. They're also talking about infusing some kind of money from the sale of non-core assets. And as I said earlier, it trades at an EV per ton of around $75 per ton. So at the lower end of the spectrum, but these numbers go down as disappointing, and both of them have disappointed quite a bit. Deepak Shenoy, founder of Capital Mind, joins us on the show. Well, Deepak, I looked through the numbers, and these numbers look a little bit disappointing. How would you approach Ramco in particular? Because that's been the big outperformer. Good volume growth, but it seems the street is getting a little bit cautious now. The debt remains at around 4,400 crores, and how much of this operational performance can continue? Your take.
To be honest, Nigel, I don't track it. In fact, we've stopped a lot of our cement tracking for a while. We're just not interested in it as a commodity play right now. So, I don't have any context around the numbers. I'm so sorry.
Okay. All right, Deepak, no problem. That is the cement space, slightly wobbly numbers from the South Indian companies like Nigel mentioned. Let's talk about, the other story of the day, which is Paytm, Deepak. Vijay Shekhar Sharma buying that 10.2%. I don't know whether to call it buy or not, because the economic interest is still, because of those debentures, it's still resting with Ant Financial. But there's so much that's gone on over here, right? The promise to a better profitability, and some of those numbers have improved, to be fair. So has the stock. The stock has doubled since the low of around, I think, 450 thereabouts. What's your sense? What would you do? Would you be interested in something like Paytm now?
So we have a conflict here. I'm so sorry again. I have to excuse myself from talking about Paytm as a company. But this particular transaction, like you said, is an economic interest transfer. And I think the ownership of the CEO will increase. Yeah, I'm sorry, I can't comment on the business as such, but because of a conflict. But yeah, I mean, I have also congratulated Vijay on this. I think it's something that is good for him to have that much voting rights in this company as well. So, just putting that out there.
Okay, so let's not talk about the stock price because of the reason that you mentioned. But what did you make of the structure of this transaction? Because as of now, I mean, Ant Financial still has the upside. They can either choose to, just keep the debentures, or they can choose to convert if they choose to do so at a later date. And what do you make of it? Because now Vijay Shekhar Sharma is going to have nearly 19% stake in the company. Should we see this as a sign of confidence, or is this a very convenient structure that perhaps worked for all parties involved at this point in time, rather than Ant Financial selling in the market?
So, I mean, of course, that is an advantage, but there's also the fact that India has had apprehensions about ownership by Chinese firms. Even if it was a financial investment, it would be considered Chinese ownership because they directly own the shares and therefore the voting rights. Now, if you remove the concept of shareholder voting rights from economic interest, which means the price goes up, somebody makes a profit, you end up with a slightly different situation. What they've done is they've removed the ownership in terms of shareholding and voting rights from Ant Financial and taken it to effectively an Indian person, which would do them well, I think, in case of any action against Chinese companies in general. And at the same time, the company that has invested does not lose economically. Because if tomorrow, for whatever reason, they say the price goes up, they retain some level of economic interest in it. So they'll only profit from it financially, but will not be able to sway or create any shareholder influence on the stock. So that, I think that way the structure is good. It addresses some concerns perhaps from regulators and from other parties, including the government in this transaction.
Okay, that's. You said you spoke to Mr. Sharma, right, Deepak?
I tweeted to him.
You tweeted. Well, this is got that. Thanks for that. We'll take a quick commercial break here. Deepak, stay with us. We'll come back. But as we do that, let's quickly hear out from Morgan Stanley's Jonathan Garner, who upgraded their rating on the Indian stock market to overweight as a top market. We spoke to him earlier in the day. Listen in. Take that break. We're back with Deepak.
For India, some of these secular drivers of the market are really falling into place. So it has moved up now, as you said, to number one in our ranking. And we think it's a time for foreign investors to re-engage with the market. Another key feature of India that we have been talking about in this note is the tendency of the rupee to be far more stable than in the past and to actually appreciate in real effective exchange rate terms versus the currency basket. India has this track record of compounding earnings now in dollars far faster than EM overall, and certainly than China. The market is not as expensive, particularly on a relative basis, as it was last October, when relative to Taiwan and Korea, it's probably the most expensive we've ever seen. It's clearly not at any kind of low valuation, but there are so many positives in the market right now that we suspect investors will be happy with the multiple. What matters in India's case for the call that we're making is things like the fiscal deficit, the way that interest rates are managed, whether or not foreign portfolio and FDI investment continues to be very strong. That's what we'll be monitoring. And at the moment, it's probably the best I've ever seen in over 2 decades covering India. So on the consumer side and on the industrials and financials, that's where we would concentrate the portfolio at the moment.
Welcome back. Once again, inching back to that 19,600 mark. The mid-caps are moving up quite smartly. The index is a gain of close to about 0.5%. Just some stocks which have reported numbers. Let's see how they're faring. Emami came out with a pretty decent set of numbers. Revenue growth of 6.8%. Gross margins have expanded by 240 basis points, but the company has increased their ad spend, as a result of which their EBITDA margins have expanded by only 60 basis points. But the stock initially reacted positively, but now is coming off a tad bit. GNFC also came out with numbers. They were flashing. The stock has slipped close to about 4%, looks weak. Top line has fallen by 39%. Margins have come down to mid-single digits, just a 6.4% margin this time, as a result of which profits are down 85%. Look at the waterfall decline that we have seen in GNFC and Aditya Birla Fashion. That's been hit hard, slammed hard for the second consecutive day. Hormuz was telling us that it's eroded a market capitalization of 24,000 crore rupees in a span of just 2 trading sessions. Another one, which is weak in trade, is Balkrishna Industries on the back of its numbers. Sonia is here with us with the fine print. Sonia.
Well, thanks a lot for that. As you rightly pointed out, Balkrishna Industries is under a lot of pressure, down almost about 5%. The reason is that there was a big drop in their revenues this time. It was a 17% fall in revenues. And the management said that they faced disruptions because of Cyclone Biparjoy. Because of that, their operations at the Bhuj plant were suspended from 13 June to 19 June. And that led to 5 days of disruption in production. And that, if you look at it, not only did it affect their revenues, but the guidance is also cautious. They say that there are challenges in Q2, not only because of what's happening in the domestic market, but also there are recessionary fears in the export market. However, on the operational front, things were not too bad. The EBITDA went up 13%. The margins rose to 23% versus 16.9%, and the profits went up 8.5%. But they also talked about how their capex spends currently stands at 550 to 600 crores. Out of this, there's a huge maintenance capex of 250 to 300 crores, and the balance will be spent towards new development like rubber tracks, giant solid tires, etc. So capex is well on track, but the numbers are very disappointing, and cautious guidance from the management has resulted in a drop in the stock.
Okay, thank you very much for that. Deepak, any thoughts on Balkrishna Industries or any of the auto ancillaries?
We used to own Balkrishna Industries. I think the company is a solid company, but I think right now its current market is going to be a little bit on the stifled side of things. Large part of its exports are in Europe, and they're going through their own sort of complexities over there, and therefore order flow is not likely to be as good as visibility was earlier. They're in the off-road market, so it's a difficult market. Their competition there is Michelin and a few other companies. They have to make like JCB or construction equipment tires or tractor tires and so on, which are different sizes for different manufacturers, unlike cars. So their margins are the highest in the industry. But I think they will face challenges in the next coming 1.5 years. And the price is reasonably high enough right now so that I don't think it really reflects that kind of downturn, kind of coming through in the next 2, maybe 1 or 2 years, because the cycles are slightly longer here. After that, I think once the earnings start to pick up again, you should see this company do well. But I think we've recently earlier this year kind of exited the stock, but still on track. I haven't seen the full numbers yet. I think the results came in over the weekend or very, very recently. So I think I still go through the numbers, but I think good company, just bad price and bad economic environment for it.
All right. Thanks very much, Deepak. Appreciate you joining in. It's always a pleasure having you with us here on CNBC-TV18. Well, let's welcome in our Alpha Manager of the Day, is Raj Mehta, Fund Manager at PPFAS Mutual Fund. Raj, good to have you with us here. Great to kind of speak with you here on the program. Prashant this side. You look at first all funds at all schemes at PPFAS, but your focus is consumption. If I were to kind of narrow it down a little bit, and in consumption, we're seeing some degree of pain, aren't we? We had last week, for example, I think it was Friday, we had the management of Titan with us. They were talking about some softness. We had Sapphire Foods with us. They were talking about some softness. ABFRL has reported numbers, I think, on Friday. seems like a demand issue. Devyani's reported numbers seems to be a problem. Britannia is another case in point. What's the call broadly, Raj? You guys have owned consumption through ITC, but not very much else. Does that still remain the stance? Stay away?
Thank you, Prashant, for having me. Yeah, ITC is the only consumption stock that we have owned in a meaningful position for about 8 to 9 years now. The only other stock or the company we had was Zydus Wellness, which was a much smaller position. Overall view on consumption is that the price that the investors are willing to pay doesn't capture the low volume growth that they are seeing across the board. So if you see the rural consumption growth, that's been pretty low for a while now. And at the same time, when people say that there's a K-shaped recovery, at the same time, we have seen some softness in the premium side of the consumption side as well. So I think that the volume growth will remain low, at least in the near term, and hence the price that is there in the market for all these consumption stocks is, I think all of them are a little overvalued to our comfort, and we are staying away from the consumption sector overall.
All right. Hi, Raj. Good afternoon. This is Nigel here. Raj, I wanted to ask you about a holding company that's part of your portfolio, Bajaj Holdings. Some of these companies, well, they've seen narrowed down of the holding company discount. Could you tell us more about that? Do you believe that that buying some of these holding companies, you get exposure to a full group of companies, could be a better idea?
Correct. So we have been holding on to Bajaj Holdings for about 3-4 years now, and before that, we used to have exposure to the Bajaj group through Maharashtra Scooters, which is still a smaller position now in the portfolio. So our view is that as long as the underlying companies are doing well, so by underlying companies, I mean Bajaj Finance, Bajaj Finserv and Bajaj Auto, and the holding company discount, as far as it remains constant, the growth in the holding company will be similar to the growth in the underlying companies. And if the holding company discount narrows, then that's an optionality that you get over and above the underlying company's growth. So in some of the companies, especially with Bajaj Holdings, we have seen some discount narrowing happening, but still it's north of 45 to 50%. So it's still huge compared to the global average that you see in the holding companies.
Okay, got that. Raj, hi, good afternoon. I remember up till a couple of quarters ago, you used to own Maruti through the Japanese parent, through Suzuki Motor Corporation. But now, at least in the June fact sheet, I see a direct ownership with Maruti Suzuki. I think 3.5% of your holdings are Maruti. I'm not sure when the change happened. Do tell us when and what the thought process is. Why not the parent? I think you've exited that position and now you own Maruti directly. So what's the thesis?
This change happened about 3 months back. So what happened was, since we are not allowed to invest incrementally in foreign stocks, the Suzuki as a position had become a very, very small position in the portfolio. So what we did was we switched from Suzuki to Maruti Suzuki. And at the same time, we exited Hero MotoCorp also. So the reason for this switch was that in two-wheelers, we are seeing a lot of competition. And at the same time, the electrification theme is playing out much faster in the two-wheelers and three-wheeler side. So it's very difficult to fathom right now as to who the eventual winner will be. And hence, we shifted to the four-wheeler side, where at least the predictability is there, at least for the next couple of years. And the electrification will eventually happen over a period of time. So I think four-wheelers right now is in a good space with the demand sustaining at least for the past 6 months or so. And we have seen the margins coming back in all the auto stocks. So with the commodity prices softening, the margins have also come back.
Raj, India's luxury market is booming and growing at a very fast pace. Just to take the example of watches. Now, Ethos, the seller of premium watches, their revenue growth went up by 33% in the current quarter. And Manglam was telling us that the average price of a watch sold has doubled in just 3 years. It used to be about 80-90 lakh and now it's become 1.7, 1.8 lakh. In comparison, Titan watches revenue growth in the current quarter was 13.5%. And that you would say largely caters to the middle income in India. So how are you playing this luxury boom in India in your portfolio?
Sure. So there are very limited companies to play this luxury theme. So one of the companies which you spoke about, it's a very, very niche market where the customer base is so small that even on a small base, it's easier to grow. But beyond a point, it becomes very, very difficult. So we have seen that in the premium two-wheeler space as well about 5 years back, where it was easier to grow up to a certain size. And then after that, it becomes difficult to grow. So the same way in this luxury market as well, as long as they are able to capture the market quickly, they will be able to gain market share in the luxury space. But beyond a point, they will also find difficulty in terms of growing their customer base. So, and apart from that, there are many very limited players per se to play on the luxury side.
Sorry, you said there also there is some slowdown. Can you give us any data points which kind of point to it?
Yeah, so data points was mainly, say, Titan in terms of jewelry. As also, we have seen some slowdown happening across the board. So not only Titan, but other jewelers also, we have seen some slowdown. So by slowdown, I mean the growth hasn't been up to the expectations that the investors had. And that's why I see that overall the consumption has been, with the inflationary trend, the consumption has been under pressure.
Okay. Raj, what about the foreign part of your portfolio? I mean, I still see all the stocks here. Microsoft is still over 5% of your holdings, Alphabet, Amazon, Meta. Any changes here last couple of months? And what's the thought now when you're looking at big tech in the US? Yeah, are you happy with your holdings?
Very happy with the holdings. No changes here. All the companies have been doing well in terms of the quarterly results that they just declared. All of them did well in all the subsegments that they are present in. Cloud computing, digital advertising, e-commerce, every segment continues to grow. And all of these mega tech companies continue to grow their market share. So no complaints there. Only complaint is that we cannot invest incrementally over there. The only amount we can deploy is the dividends that we receive from these companies. So yeah, that's...
So while you own big tech, US big tech, you also own a small position in Infosys. I think it's just about 1.5%, not too big. So leave us with a thought there, because I mean that's where the biggest question marks are on large Indian IT services companies. What do you think?
Sure. So we also have a position in HCL Tech, which is about a 5% position. The view there is that your expectations need to be muted. So what we have seen is that last couple of years, these IT companies have had a phenomenal growth, and the expectations of the investors also went up simultaneously with that. So if the expectations are muted, and if you look at the longer term growth of most of these companies, it's been in the range of mid to a high single digit kind of constant currency growth. So if you have those kind of expectations, I think these companies over longer term could do well. In the shorter term, you could face some pressure, but the shift to digital is here to stay. And most of the companies will spend on the digital side going forward as well.
Raj, thank you very much for joining in. Need to slip into a very short break. As always, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We'll also get you a few BTST calls from our experts.
Welcome back. You're tuned into Closing Bell. Well, the market's hovering around the 19,600 odd mark. The problem today has been the Nifty Bank. That's not participating, and that's preventing the Nifty from getting past the 20 DMA. Well, let's find out what's going on into D Street chatter. Nimesh, what are you picking up? I mean, pretty decent session, but it appears at high levels we've seen some supply.
Yes, Nigel. And as you rightly pointed out, the drag is in the financials, and that's largely because there is selling pressure, especially in the select private bank names from the larger FIs. So that's the overall feedback. Even if you look at the Q1 numbers for financials, it's largely been either in line or a bit of a disappointment. So that's playing out in terms of a little bit of underperformance in the bank stocks. So that's the overall feedback. But the flows are quite mixed. In fact, the volumes are on the higher side. So that suggests that the participation is there from the larger institutions, both FIs as well as the DIs. The two sectors which clearly stands out, one is pharma and the second is the PSU stocks. Both have been outperforming off late, and that continues in today's trade as well. And today, for a change, again, some bit of buying traction is back in the rail PSU names. So all the rail PSU stocks are buzzing in trade today. But one thing which I track it very closely, and I'm quite excited as well. And I said this on Friday as well in my Friday this thing as well, that maybe that promoter selling has started picking up.
Yes.
And that's actually showing up. So I'll add to my chatter as well. But largely that's the trend which is picked up, and the sense I'm getting is you're going to see much more such blocks in the days to come.
Oh, interesting. Then Nimesh, run us through the list. I mean, what all are you picking up on individual counters?
So in terms of individual names, the first target on my list is Adani Green. Again, there was a large block, nearly 3% equity got changed hands today. I believe the promoter entity was a seller in today's block, but in terms of buyer, a single entity was a buyer in today's Adani Green block. In fact, I understand one of the large sovereign fund was a buyer in today's block. So that would be an interesting name. I mean, the name will get disclosed, I believe. So that is something to track in Adani Green. So that's the first one. Second stock is Shivalik Bimetal. Even in that stock today, if you look at the intraday chart, the stock had fallen more than 10% after a large block. Even in that block, I understand the promoter entity was on the sell side, and some hedge funds were buyers along with a domestic AIF who was a buyer in today's block. So that even there the disclosures could be important. The third stock is JTL Industries. Again, this is one stock in the mid-cap space, done really well off late. It's buzzing as well. And even in JTL, there is a strong buzz that there is a large block coming in JTL very soon. So that's to track in JTL Industries. And the last stock is Zomato. After what we saw on Friday's trade, a big move, even in today's trade, on huge volumes, the stock is buzzing in trade. I believe some large long-only funds have started active buying again in Zomato. And hence, large volumes and a big mover even in today's trade.
Oh, yes, it has been indeed. What a big mover, Zomato. Dream run, really, 70% this year. And the street's still lapping it up. By the way, we had those numbers coming in from Barbecue Nation, and they were not appetizing at all. Big drop in profitability, and that stock's down about 5%. That's Zomato. It's kind of losing some ground now. Overall on the market, we are still holding up. In fact, the Nifty is still very much around the 19,600 level. Barbecue Nation is the big disappointment. Those are result reactions that are just coming in. I think we have Mitesh Thakkar with us now. Can we go to Mitesh for a quick call? I think we have him, yeah. Mitesh, good afternoon. So what's the sense now? What are the stocks you're working with, or any other further advice on the index?
So I think on the index, we maintain a negative position, though I think, while we got to a high of 19,620 today, we haven't taken shorts. I was waiting for 19,650 odd levels to go short in the futures. So holding on to the put options positions. And on the stock side, I have a PTSD on TCS with the stop at 34.65 for targets of 35.20, and REC is a BTSD as well with the stop at 209 for targets of 216.
Okay, thank you very much for that, Mitesh. One of the stocks of the day has been M&M. It was the top Nifty gainer for the longest time, but it's been surpassed by Divi's Laboratories. So right now, when you look at the pecking order, it's Divi's Laboratory up 4.5%, and then you've got M&M with a gain of 4.2%. It's been a solid performance from Mahindra & Mahindra in Q1. Revenues has seen a strong surge. Margins jumped by 240 basis points. Both farm equipment and the auto business have seen margin improvement. We had a chat with Anish Shah, Managing Director and the CEO at M&M, and he spoke to us earlier in the day. Listen in to what he had to say.
Nothing at all. We don't expect anything to change for the next 2 to 3 years. As I said, it's a profitable option play. And just going back to your point, the capital allocation policy remains as firm as ever. In fact, we've strengthened it even more. And our focus is really to create value. And it's not just about where we allocate capital, but the execution on that as well. And that's something that we've demonstrated in a very strong way. We see lower margins when a new vehicle is launched because that's part of the cycle. It's part of building the brand. It's part of being able to reduce costs once we've got certain volume. And that's what will likely happen when every new vehicle is launched in the electric space. But as I said, we expect that to be 20 to 30%, so not a very significant number. It's a very good space for us to be in today before we launch our whole range of electric SUVs.
Okay, that was M&M's Anisha. We have Sudeep Bandyopadhyay, Group Chairman at IndiTrade Capital, now joining in. Sudeep, good afternoon. Good to have you on the show. Let me actually ask you about Mahindra & Mahindra because it's been an interesting roller coaster ride ever since they announced that 3.5% stake purchase in RBL Bank. Now the management has offered enough clarification. The performance was fine, first quarter performance. What's your take on the stock?
Well, so we have been positive on Mahindra for last almost 1 year. I think all the businesses, have started firing. EV, there has been a lot of developments, and that's a good thing because the market loves the name EV. And as soon as there is something connected with the EV, market gets excited. But Mahindra has done some groundwork. There are some investments coming from Temasek. Today's interview I heard on your channel, and I think probably they will spin it off, in few years' time once things stabilize a bit on the EV front. The tractors have been doing well, and they've been doing well consistently. Leave aside, a few months here and there, but by and large, last 1.5 years, tractors volumes have been decent. SUV, they had suffered quite a bit earlier, but now they have picked up, and I think they're doing very well. The new models are gaining traction. So the business has been doing very well. They also have exited all the foreign subsidiaries, which they had promised to get the capital allocation right. So all the things around Mahindra & Mahindra have been good. Performance has been good, except the RBL stake acquisition. That's a joker in the pack. And in spite of all the explanations, and believe me, I've very carefully heard all of them, still doesn't make much sense. Investing about 400 crore, for learning banking. I really don't know. We just can't understand this yet.
Okay. By the way, guys, the SEBI annual report for FY23 that was put out earlier today. Sudeep, I'm just coming to you with a question around this. So maybe a little out of syllabus, but this is interesting, and I'll tell you why. So SEBI is saying, amongst the things that they've listed out as things that they want to do in FY24, they say this. They say that they are going to review the eligibility criteria for stock derivatives, and they say that they're going to review the criteria. They say the sort of note says the last review of the eligibility criteria for introduction of stocks in the derivative segment was done in 2018. Since then, broad market parameters reflecting the size and liquidity of the cash market, market capitalization and turnover have moved up considerably. Accordingly, it is proposed to review the eligibility criteria for introduction and continuation of stocks in the derivative segment. Not just introduction of new stocks, but continuation also. I mean, of course, markets themselves have come a long way from that point on. And SEBI is now basically saying that they want to kind of review it. 2018, just to give you the difference in terms of the size, right? The index closed that year at 10,800 levels. We are at almost 20,000 levels. And of course, I mean, this is just the index, which is double, but the changes in terms of stocks and everything else has been massive. So SEBI is now saying that we will review the criteria. So the context in which survey this is important is because of DMart, Avenue Supermarts. That's the reason why we are kind of picking this up. My colleague Anuj had earlier put this out, with regards to asking the question. I mean, I think this was a couple of years ago, asking the question why DMart, with its sort of size, market cap, liquidity, etc., is not part of the F&O list. So we don't know whether this is with regards to, I don't think this is, I mean, usually they don't change regulations for one thing. It's a broad review, but I mean, I think it'll again raise the question at least whether these changes, etc., will bring Avenue into the derivatives fold, stock derivatives fold. Sudeep is with us. Sudeep, any thoughts at all on this?
No, Prashant, I think you put out pretty nicely. I think in a dynamic situation, dynamic market like India is today, the review frequency needs to change. And yes, it's 5 years. The world has changed quite a bit. We had COVID. We had a massive market rally. Market has almost doubled from the levels where it was. A lot of new companies have come in. A lot of listings have happened. So I think it's absolutely right for SEBI to review both introduction as well as continuation of stocks in the derivative segment. And you're absolutely bang on that. Avenue Supermarkets, why it's not there is everybody's question. When the Reliance demerger happened, and even before that, there have been a lot of talk that why not include Avenue Supermarkets in the index, in the derivatives segment. So I think this review will hopefully comprehensively bring in new criteria and a new way of looking at inclusion and exclusion from the derivatives list.
All right, guys, just to weigh in, a couple of parameters that are there, the average traded volume, the market capitalization, you can get those. The other one is the quarter sigma, which only the exchange, they calculate and they give it, which includes the impact cost as well. So just one quick point here, that in case DMart comes into the F&O market, whenever they choose to review it and have a look in it, well, you'll say that, hey, it may not sustain at these current valuations. But the criteria for DMart to get into the Nifty as well will be that it has to get into the F&O market. So we'll have to keep an eye on that. First conclusion, if DMart is the one that, we're focusing on, then getting into the F&O market makes it eligible to get into the Nifty as well. As of now, that it's not fulfilling that criteria of trading in the F&O market. That's why it's not part of the Nifty. Otherwise, at the last review, it should have definitely made it. But we'll track this. Interesting times. As I said, average traded volume, market capitalization can be calculated, but the quarter sigma, the one that the exchange calculates, that's only available with them. For the time being, slip into a short break, come back. Our final 10 minutes of trading action.
Counting down to the close, and the top loser in terms of the large cap names is Britannia, as it goes home with a cut of close to about 3% on the back of a weak Q1 numbers. The company has reported flat volumes. The street was anticipating a 5 to 6% volume growth, and the company's margins too have slightly disappointed the street because the company took, cut their prices to combat local inflation competition. Sudeep Bandyopadhyay is still with us. Sudeep, would you buy the dip on Britannia?
Not really. I think I'll wait. There is real competition, and the margins are coming down. They have to make their other businesses also work. They have been talking about for a very long time about cakes, and other bakery product to also start working, but it hasn't really made any meaningful contribution as far as Britannia is concerned. It's definitely only a biscuit company, and in biscuit the competition is increasing. With the raw material prices coming down, I think the scope for competition also is enlarging, and with that, margins will definitely be under pressure. Under the circumstances, the kind of valuation it is putting, I think I will wait and watch. There are other better FMCG plays to buy into if somebody is really keen on FMCG.
Okay, that's a take on FMCG. By the way, Sudeep, I mean, some of these stocks on the mid-cap side, these railway stocks, they have been just shooting through the roof. Not quite sure what's happening here. And I'm not just talking about the wagon makers or the Vande Bharat orders, but even, government companies like IRCON, IRFC, these are stocks that have been on a tear. Any thoughts around these? Would you look at some of these related railway plays?
Well, I think obviously, Surabhi, overall, what's happening in the railway sector is unprecedented. We have never ever seen something like this happening. At one point in time, there are railway stations which are getting completely revamped. There are new wagons which are coming in. Vande Bharat has been a big change. They are also talking about revamping the signal infrastructure. So overall, there is an excitement, and probably most of the companies involved with railways in one way or the other will benefit over the next 3 to 5 years. But if I have to really bet, I probably still will go back to a Titagarh or a Texmaco. I think Titagarh, of course, has been doing very well, and market also has rewarded them. Texmaco hasn't in the past got their act right, but I think they are trying to get their act right, and things are falling in place as far as Texmaco is concerned. If I have to take a bet, probably I'll go and buy Texmaco at this stage. I'm not very confident about these, ticketing companies or financing companies or even the consulting companies in the railway space. I'm not sure these PSU companies will perform wonders or not, but the companies which are directly linked with the growth of railways, they should do well, and that's why my bet will be on railway wagon and railway coach manufacturing companies at this stage.
Okay, all right. We'll leave it there, Sudeep. It's a pleasure. Thank you very much for joining us on this edition of Closing Bell, as always. Thanks indeed. Well, let's take a quick look at the market close. 80 points higher, so not quite above the 20-day moving average, which was at 19,626. The high today was made earlier in the day at 621. So almost there, and then some selling coming through. But this is strong follow-through on the Nifty after what was a strong day on Friday. So this is nothing to scoff at. Bank Nifty ends absolutely flat, middle of the day, almost at the low point of the day. The low was 44,773. We kind of end at 44,800. So not very far away from the day's lowest point for the Nifty Bank. Let's look at the mid-cap index. Mid-cap index will end about 0.5% higher. And you got the small-cap index, which ends about 0.25% higher. So this is the overall picture. Market breadth is positive. 300 stocks separate gainers and losers. So more up than down, but lots of stuff down as well. On volumes, lots of earnings-related pullbacks. Actually, majority is earnings today on the downside. So that's not really great news, but bird's eye view. This is an up market, and one more day of repair after last Wednesday and Thursday. The market lost about 350 points. Prima.
Well, some of the big earnings misses, Britannia and State Bank of India in the large cap space. Outside of that, You had Bank of Baroda also, where the NIM compression was more than what the street was anticipating. The stock corrected. You had weakness coming through in India Cement, Ramco Cement, as both of them. Both these cement companies from South India disappointed the street. Aditya Birla Fashion slumped for the second day in a row. GNFC margins collapsed, stock down close to about 5%. And you had many, many other earnings misses, whether it's Venky's or VRL Logistics, Naveen Fluorine, Delivery, all these stocks saw a big fall.
Well, they did, but there were also a lot of gainers beyond the index. You have names like Paytm, obviously. Smaller entry like Sequent Scientific rallying about 7% today. REC, both PFC and REC actually managing a decent sort of day for themselves. If I talk about some of the movers and shakers on the upside, then the stocks that we were just discussing, some of the railway names like Aircon up about 6.5%. Hoodco, another government name, about 5% higher. Graphite India, 5% higher. So it wasn't too bad actually on the mid-cap market. You had a fair amount of movers on the upside as well. Max Health, look at this one, about 9% up on Max Health. Poly Medicure, basically healthcare as a space. Yatharth, today's listing, of course, up about 10% as well. So healthcare as a space having an extremely good session as we end the day. Mid-cap index up about 0.5%. Nifty up about 0.4%, as is the sensex. Bank Nifty was the problem. That was the spoil sport of the day. Well, with that, we are going to take a very quick break. We'll come back on the other side and get you excerpts from our exclusive conversation with Jonathan Garner of Morgan Stanley on why they have upgraded India to one of their key markets. Stay tuned for that.